Welcome to Blain's Morning Porridge. It's the 21st of January 2026. Beware the Judder moment in bonds. As always, let's start with a quote. A pebble falling down a mountain in Japan may trigger momentous events in Nuuk. Trump dominates the headlines, but watch what's happening in the bond markets. Yesterday, Japan bond yields juddered a warning about political competency risks, but also how rising geopolitical and conflict risks are resetting investor expectations. When the bond market speaks, you really ought to listen. Plus, Air Force One, Bitcoin, and Howard Lutnick. In bond markets there is truth, as shall be revealed later. In Trump, less so. Trump. He utterly dominates the news flow. Some Americans have lambasted me for my recent comments about him, calling me rude and ill-informed. They parroted all the Trump lines back to me about the only way to defend NATO is to destroy NATO, or something like that. More Americans have told me they agree completely, confirming to my mind that there is an increasingly dangerous polarization of the USA underway, which could metastasize into something more truly malignant. So I would advise everyone to put rising US political risk and domestic pressures on your threat board as the November midterms approach. How much clearer can I say it than that? But if you really want to ruin your day before Trump's much-anticipated Davos appearance, then I might suggest reading Howard Lutnick, US Commerce Secretary, in the Financial Times this morning. He's got a piece there entitled Why the Trump Administration is Going to Davos. It's subtitled Capitalism is the New Sheriff in Town. It is a comment completely lacking in self-awareness and of extraordinary arrogance, profoundly depressing and very revealing. Macron is right. We really do need to show these guys the door. The thing is, Trump noise is distraction, but it is driving destabilization. The market risk is it triggers a very real monetary fiscal crisis if the confidence that currently underlies global markets gets broken. It is possible, and my best guess is it will stem from a contagious breakdown of the global bond markets. And if that happens, then all financial asset bets are off, and the only place to be will be gold. Forget Bitcoin, and I've got a comment on that at the very end of this morning's comment. But let's start off this morning with a digression. Air Force One. Air Force One is a metaphor for Trump's brilliant handling of the US economy. This morning, the president's flight to Davos was forced to return to Washington after electrical issues. It's broken. Much to the relief of Davos, Trump's appearance may be delayed until later this afternoon. And it's really no wonder that the plane broke down. The two Air Force One jumbo jets are 40-year-old constellations of plane parts flying in formation, held together by constant repairs, string and electrical tape. Think of them in the same way as you'd have thought about Ronald Reagan flying in an old Douglas DC-3 to critical international meetings. And that's because back in 2017, during his first presidency, Trump decided to demonstrate his business acumen. He unraveled a $4 billion order the US Air Force had placed to supply and build two brand new state-of-the-art military specification B-747s, that's the old jumbo jet called a VC-25B in the US Air Force, and they would have been delivered to President Biden in 2022. Trump cancelled the order, and he instructed the US Air Force to buy two planes that were sitting in a desert boneyard. They were originally built for a bankrupt Russian airline, Transaero, and he told them to convert these aircraft instead because it would be much, much bigly cheaper. Delays and difficulties with the conversions, which the US Air Force had warned Trump about, means that the planes won't actually fly till 2028, right at the end of his current term and possibly much later. There's actually a fantastic and brilliant straight-faced documentary on Disney about this called Flying Fortress, I think. The cost of these aircraft now exceeds $8 billion. And as for the Qatari jumbo jet, the 13-year-old flying gold brick as it's known, is never going to meet US Air Force specs, and it will likely go straight to Trump's presidential library, raising all kinds of governance issues over the gift that was made to him. Anyway, enough of digression, let's get back to the bond market. And the obvious place to be looking for clues is the Japanese government bond market, or JGBs as we call them. Yesterday, Japanese bond yields spiked higher on the back of an unfunded tax cut announced by Prime Minister Sani Takaishi ahead of next month's elections. Now, Japan's outstanding debt is huge. It's enormous in relation to the size of its economy. It's 230% of GDP compared to 125% in the USA, 95% in the UK, and around 90% average across the Eurozone. Some countries are higher, some much lower. Historically, it's never been much of an issue for Japan because of the very high propensity to save amongst Japanese consumers and the very high holdings of JGBs by domestic institutions. But suddenly, and because of rising global tensions, JGBs are flashing warning signals. The instability and the uncertainty milling around Trump's unpredictability and unreliability and the rising risk of conflict over Japan are at heart. China is furious with Takaishi because she has committed Japan to defending the island, and that means Japanese bond yields are again become the kind of canary in the coal mine for the risks of a potential global bond sell-off. If it can happen in Japan, it can happen elsewhere. Now, Japan bond yields have been rising steadily this decade since the Bank of Japan wound down its decades-long policy of maintaining very low interest rates and yield curve control, which it did through bond buying, effectively an early form of quantitative easing, QE. And that policy was originally intended to persuade Japanese savers not to save their money, but to spend more. And it also kept interest payments on the massive quantum of government debt very low and therefore sustainable. And when QE ended, everyone understood that a natural bear market would follow as the market sought to establish a new equilibrium rate for GJBs. And that kind of happened, but it did trigger some hiccups as rising rates and the sustainability of that enormous quantum came under question. Fears about Japan's massive outstanding debt and the question of whether a bond crash in Japan might trigger a contagious global loss of confidence in other government bonds did come to be asked. Now, these concerns all reflected the Liz Truss debacle that occurred in the UK in October 2022, when the shortest-lived UK Premier's ill-considered, unfunded budget bombshell of unfunded tax cuts and spending commitments caused the gilts market to skid, triggering margin calls on billions of pounds worth of leverage trades known as liability-driven investments, which nearly caused a chain reaction which would have triggered a complete meltdown in gilts. Think of it as a kind of China syndrome if it had happened. But now the crisis facing the bond markets is different. We not only have the political competency risks that we saw with the Liz Truss incident around unfunded tax cuts and spending causing the quantums of debt to rise, but we've got interest rates that are becoming more and more unsustainable, and that raises questions for what we call the bond vigilantes about the sustainability of debt. But on top of all these normal factors, we have the rising external risks of geopolitical instability and the risk of conflict, plus the potential of global bond buyer strikes in reactions to things like tariffs. Now, what bond investors care about is being repaid principal and interest in a timely manner. Any government with financial sovereignty, and by that I mean ownership of the monetary printing presses, can always do that by printing more money. But that has a consequence on the currency. And that's why investors look for the virtuous sovereign trinity of well managed economies which demonstrate one, a stable currency, two, a sustainable bond market, and three, political competency. Now, Japan still ticks these boxes. I don't believe that Japan's debt load is a massive problem. Its debt is in yen, so it doesn't face a currency risk on its debt. And the holders of its debt are primarily Japanese. There are not enormous inflationary pressures in the Japanese economy at the moment. But when Japan debt yields spike higher, because of concerns about political competency, geopolitics, and conflict risks, then it highlights the problems that may exist for other nations. And the USA is that nation to worry about. We've already seen Trump commit to massive increases in military spending, which is going to increase the overall deficit way, way above the $38 trillion the USA currently owns. The military spending will add 5 billion trillion to that during Trump's current administration. Now, that raises a whole series of questions for the USA, and potentially it could be failing in the minds of investors the political competency test, the currency test, and the debt sustainability test. And the reason for that is that 30% of US debt is held by foreigners. Now, most of that is across widely diversified funds and financial investors and other entities. And as price moves have shown in recent days, US treasuries have not responded as they have in the past, as the ultimate safe haven asset. Trump's disruptive mayhem has caused bond yields to spike, to go up in a period of conflict by over 15 basis points. Normally, it would have been the other way because of fear. Now, while some nations may instruct their state entities to sell treasuries because of their displeasure with Trump, citing raised political risks in the USA, it's highly unlikely there will ever be a coordinated, across the board global sale of 30% of US treasuries by all the foreign holders. Just not going to happen. I mean, what else would they buy? Instead, it's very likely we'll see what's already happened in firms like PIMCO, where investment committees simply make the call to de-risk because of the rising political risks and conflict risks and lighten their positions in treasuries. We know that many funds have already made that call. Over time, the USA will be able to absorb that debt that is now held overseas, which will mean they either have to manage the liability through things like quantitative easing, which has all kinds of knock-on effects, or they raise interest rates, all of which are going to impact the US currency. And that comes to the next part of the problem, which is even though US bond yields may fall due to the Fed reinstituting quantitative easing, which is likely to happen after Trump captures the currently independent central bank later this year, global investors may decide to avoid such a false bull market. They would be right to do so because it's likely that concurrent with any US fall in interest rates, we will see the currency fall. The dollar's going to fall because interest rates are lower, and that would wipe out any of the bond gains. Plus, we are seeing, because of Trump's acceleration of this process, the dollar's exorbitant privilege as the currency of global trade beginning to diminish quite quickly. And that means there are less US dollars in global circulation, which tend to get placed to fund the treasury market. And if the Fed is pumping liquidity into bonds, but bond yields remain stubbornly high, then that cash, which had been absorbed into financial assets during the last era of QE from 2010 to 23, then that will go straight into the economy instead, and the result will be massive inflation. And if that is combined with the recessionary effects that Trump's America First policies are beginning to generate on the US economy, then you get full-scale stagflation, at which point all kinds of currency and interest rate problems consequentially hit US markets and trigger even more increased political ructions as it becomes clear to US voters they've bought a pup. Now, Europe will not be immune to this, and the UK also has very high external debt. So this is very much a watch this space in the global bond markets. But let me give you some final thoughts this morning on Bitcoin, because I've had a number of calls, people saying they should be piling into Bitcoin because of the rising risk. Well, I am not a Bitcoin fan, and most people know that. Now, there's a chap called Christopher Woods. He's the author of a very widely read investment letter called Greed and Fear, and he has eliminated his 10% Bitcoin position from his flagship model portfolio. And the reason he's done that is that he reckons the advent of quantum computing is going to massively undermine Bitcoin. Although quantum may not happen for a few years, the mere threat of its approach could be enough to make many current Bitcoin holders fear that it could become a stranded asset in the future. Now, concerns over Bitcoin and quantum are legion. Crypto assets are currently considered unhackable with current computing tech. Quantum will be powerful enough to crack private keys, thus allowing crypto thieves to ransack Bitcoin wallets. Possibly even some of the original founder wallets, the Nakamoto set, for instance. Now, Woods wrote in his piece that it undermines the concept of Bitcoin as a store of value and therefore as a digital alternative to gold. And that's a very interesting step back from Woods, who has been one of the more thoughtful supporters of the Bitcoin market. He'd previously accepted that Bitcoin was a store of value with genuine attractions in an increasingly volatile market environment, the kind of thing that we're currently seeing. And he cited the positive US regulatory acceptance of Bitcoin last year, taking its lead from Trump. And he liked its limited supply. There can only ever be 21 million Bitcoins. And he believed it would continue to perform until very recently. He once even posted a $150 per Bitcoin target, and now he's replaced Bitcoin in his portfolios with gold and gold miners. Now, I have a feeling the quantum revolution gets closer in direct proportion to just how loudly crypto shills are screaming that it won't ever happen to their precious Bitcoin. Well, it's going to. Anyway, that's enough for today. I'm out of time and I have to rush to go catch a train up to London. So I will be back tomorrow on www.morningporridge.com with the full morning porridge, which you can sign up for and get delivered fresh to your inbox every day. Otherwise, I will be back with, I suspect, a write-up of whatever nonsense Trump comes up with in Davos. Thanks very much for your time.